Hi guys, welcome back. Today our topic will be carry trade. Now, as we discussed in fundamentals, every country's central bank has an interest rate. If the interest rate is high, the currency is strong. If it is low, the currency is weak. Today we will discuss whether we can make money from that interest rate, and even if you don't want to make money from the interest rate differential, we need to understand that these index differentials affect the market and the long-term movement of the currency. The long-term movement of a currency is affected by the interest rate differential. The currency with a strong interest rate will be strong. The one with a low interest rate will be weak. Now, what are the reasons for this? The reason is that when we do carry trade, what we are basically doing is borrowing a low interest rate financial instrument. We use that to buy higher interest rate instruments. For example, I borrowed $10,000 from the bank. Okay, the interest rate on that is 1%. Then I went and bought bonds, and the return on the bonds is 5%. So 1% will be my costs. I made a 4% interest differential profit. What do we do in Forex? We borrow one currency and invest in another currency. For example, we bought USD JPY. We bought the dollar in USD JPY. So basically, what did we do? We borrowed the yen, and from that borrowed yen, we bought the dollar. So when we borrowed the yen and bought the dollar, what happened? We will get the profit from the interest rate differential. If, for example, the interest rate on the dollar is 4% and the interest rate on the yen is 0, I will continue to get a 4% profit. Similarly, when we leverage a position in a carry trade, for example, just like after a loss, a leverage position gives us higher returns. Similarly, when we leverage a position in normal trades, our return ratio increases because the return will come according to the lot size we use. Okay, now we understand that carry trade works. Carry trade has many advantages. But it is essential to understand when carry trade does not work. When there is risk aversion, people panic, they focus on yields. When there is economic certainty and people prefer safe haven currency, okay? The condition of both countries is good. One has a lower interest rate, one has a higher interest rate. So the currency of the country with the higher interest rate will be strong. But if the currency with the higher interest rate experiences economic collapse or recession, or its economy lacks economic stability, as we can see in India and Pakistan, then what happens? The currency becomes weak, which affects the gains we make from a normal interest rate return. We lose more in currency devaluation than that. So it is very important for us to choose currencies between interest rate differentials, but also by looking at other fundamental factors. So therefore, we need to look at high interest rates and ensure that the currency we are choosing is stable and in an uptrend. For example, buying dollar yen. The dollar has a higher interest rate, the yen has a lower one, but when will I buy it? I will buy that at a lower level. I will not buy from the top. So if, God forbid, the currency goes against, starts to fall back, then I would be in a good position to exit, instead of being at the top where I would have to sustain losses. So what we do, we combine technical analysis with fundamental analysis and with the basic knowledge of interest rate differential. Now, when we do carry trade, we need to understand the risk of carry trade. What is the risk? The biggest risk is if the currency that is giving a high return has its future interest rate expectations change, or if its economy comes under more pressure due to higher interest rates and there are chances of interest rates falling, then what will happen? There are very high chances of that currency weakening. So we have to be very careful. We need to keep an eye on risk reversion and risk mood to see if the market is investing in risky assets or not. Now, sometimes if a commodity currency or a normal currency has a high interest rate, but risk aversion occurs, panic is created because of any reason, any geopolitical reason, any economical reason, then what will people do? People will move towards those currencies that are safe havens. What will happen in that? In that, even a high interest rate currency can cause you losses. So you need to understand how we can manage our risk when we are in a carry trade. For that, we can use stop loss orders. We will keep an eye on economic and political developments to ensure that future expectations and interest rates do not change and risk aversion does not occur. Keep your portfolio diversified. Do not keep it in one asset, but in multiple assets when you are doing carry trade. But if you are doing spot trading, you need to focus on one currency. We have discussed this before. So what is the conclusion of this chapter? Why did we study this chapter? Normally, retail traders do not get into this, but it is essential to understand that the market movers invest from millions to billions of dollars. For them, a 5% return, a 3% return is a lot of money. So they focus on high yielding currencies and invest in high yielding currencies. So when they invest, the market will go up, and when they take profit, the market will go down. So we have to understand that carry trade is a market mover. So we have to keep all eyes on that. We have to always keep an eye on it. Okay.